Hey everybody, welcome back to Homebuyers Academy 2025. I'm Ryan Robarchuk with Long Realty Jasper Associates. In this section, we're going to start talking a little bit about lending and financing. So if you're not going to be paying cash for your property, you're going to need a loan. And this is what I want to talk about in this section. Talk a little bit about what the types of lending there are, some of the things to consider when getting a loan, and some other things to consider while we're going through the lending process. So first and foremost, your credit score. And your credit is what demonstrates your ability to repay your loan. So one of the things they look at are credit scores. Can be anywhere from 300 up to 850. Most credit scores with the general population of Americans is going to lie somewhere in the middle, around that 650, 700. Some of the things that can impact your credit scores are late payments. So that could be rent, that could be credit cards, that could be card payments, that could be mortgages that you may have on another property. Bankruptcy, whether it's chapter 7, 11, or 13. Tax liens, so if you've got back taxes. Collections, could be from medical bills, student loans, credit card debts as well. Disputed credit items. So even though you may think that you're right now currently in the conversation with a credit card company and you're disputing it and you're decided not to pay your credit card bill because it's under review, that could also impact your credit as well. So these are all things that you want to keep in mind about keeping your credit score in that desirable range. And if you've got any of these things that are pending, you may want to address them first. Income. That's the second piece, your ability to actually financially repay that loan. So if you're self-employed, one of the things they're going to look at are 2 years worth of history. They're going to look at, and when I say they, I mean lenders. Lenders are going to look at your salary, whether you're hourly, any commissions and bonuses. If you're self-employed, they're going to want to see at least 2 years of tax returns. And then what they're going to do is this thing is called debt to income ratio. So what that is how much debt you have to the income, and then they divide it because you take two numbers, you divide them into each other. That's how you get a ratio, and that's going to determine your ability to take on this loan, and do you have enough income and resources to pay this loan back. But there's one thing that you can do too, is we want to look at also down payment and your assets. So down payment is the amount of money that you would need to put down towards your loan. So different loan programs, FHA, VA, have different, and conventional have different down payment requirements. And that down payment actually goes towards your loan, and it reduces the loan by that amount. So you can be anywhere between 3.5%, VA, conventional, and FHA. Also want to consider closing costs. So closing costs are money that you need to bring to the table. Escrows, prepaid, and any impounds. So that could be HOA fees, anything that, in addition to the down payment that you may need to bring out of pocket. We can also get discount points as well. You can use money to buy down those points from your lender, and it could be from multiple sources. So it could be from your checking, it could be from your savings, 401, any other investments. So you've got mutual funds, you've got stocks. You can also have gifts from family members that can give you money towards buying down any of these things, or even using towards the down payment. There are things called seasoning requirements, though. So seasoning requirements are something that you want to make sure that the money is given to you and it's been in your account long enough. And so it could be anywhere between 30 to 90 days. It all depends on which lending program you're using. But there's a number of different things that you can use for the down payment. In this particular market, at the time of this training, we're seeing buyers willing to give concessions to buyers to buy down their interest rate, to cover some of their closing costs, or to cover some of the other fees that we just went over here. Third-party contributions. So when I say a third-party contribution, one of the things that we can ask for as a buyer to the seller is, can we get concessions? And what concessions are is usually a percentage of the agreed upon purchase price that the seller can use to cover a number of those things that I just mentioned in the previous slide. So with FHA, if you've got a $500,000 home and you get up to 6% in concessions, that's $30,000 that you could use to offset some of those costs. The thing we want to remember with concessions is, if you get more than you can use, you're essentially leaving money on the table. So this is where having a sharp agent that can tell you exactly what would be in your best interest, help you make an informed decision, and take a look at the overall offer, so that way you're not getting more than what you can use. For VA, it's 4%, Fannie Mae and Freddie Mac 3%, and DPAs anywhere between 3 to 6%. So when we talk about conventional loans, we're talking about Fannie Mae and Freddie Mac. And we just talked about the down payment requirements. There's a credit score requirement. There's debt to income ratios. There's maximum loan amounts. Conventional loans do have appraisals too. So all of the loans that we're going to talk about today have appraisals. Now, I'm not a lender. This is just the best course of action if you got really detailed questions, is to partner with a lender and have him or her tell you what's going to be the best opportunity or the best option for you guys. So FHA loans, again, there's a down payment requirement, there's a credit score requirement, there's also debt to income ratio requirements, there's a maximum loan amount, and it also will have appraisal as well too. And then VA loans, so these are for veterans, and there is a down payment requirement, but with VA loans, you can also get your down payment back at closing. So credit score, debt to income, maximum loan amount, also there's an appraisal going to be required. Pretty much for any time you get a loan, you're going to have an appraisal done. Down payment assistance, so different lenders, banks, programs have down payment assistance. It all depends on your particular scenario and situation. There's for first-time buyers and for repeat buyers. Sometimes there's income restrictions as well. Maybe you make too much and you don't qualify for down payment assistance. Maybe you fall below a certain threshold and you're eligible for down payment assistance. But there is no such thing as a free lunch. So this is where talking to a lender is going to be very helpful. So a couple of other things that we want to take into consideration. So if they're non-occupant co-borrowers, so say somebody is co-signing a loan, like maybe a friend, a family member, somebody that's basically signing it so you can get financing, but they're not going to be living in the property. There's blended debt to income ratios. Condos versus townhomes. Very different than a single family home. So in some condo and townhome communities, they will only allow a certain amount of FHA. So they'll only allow a certain amount of VA as well. So there's discount points that come into play. And one of the things that you want to take a look at or understand, depending on the loan that you have, is what's called mortgage insurance. So basically what mortgage insurance is that it is an additional insurance or fee that is tacked onto the loan. And that what that does is that basically ensures that in the case of default, there's additional funds there to cover it. Again, a lender will be able to explain those to you and be able to walk you through which ones have it, which ones don't, how do you get out from underneath it, those sort of thing. And pretty much that's it on the finance and lending section. Thank you.